Raul, they say that, Bitcoin is like, this is the meme, right? Bitcoin is your hedge to inflation because, every time they print money, but Bitcoin is, there's just going to be 21 million Bitcoins ever. But the crypto market is so heavily correlated to the public markets that it kind of doesn't really serve that purpose anymore, which is, it almost feels like every time there is QE, Bitcoin goes up because isn't it like correlated to inflation, but not in like a hedged way?
Okay, let me explain it for your Indian audience. Why do Indians buy gold? So when you look at gold in rupee terms,
Hmm.
it's gone up. What has the rupee done over the last 20 years? Gone down. Why? Because of inflation and central bank policy and those kind of things. Indians buy gold because it maintains their purchasing power over time. And it's worked astonishingly well. It's the same with crypto. What you're hedging here is not inflation, i.e. prices rising, which is usually demand or supply driven. What you're hedging is the debasement of currency, where your purchasing power goes down. So, okay, let's go back one step. What is Bitcoin? Bitcoin is a scarce digital asset, and we either choose to accept it or not, right? Like everything, like gold it's just a metal, but the meme says we should accept it as something of value. So Bitcoin is a meme that is the digital store of value. But it is also a technology. So if we think of Ethereum now and the rest of the crypto space, this is a new tech of which we can use blockchain for a whole bunch of different things. So what we've got is this scarce asset and technology. Okay, great. That's worth something. The other side of the equation is, as you mentioned before, these however many white dudes, aging white dudes in the United States, set the monetary policy for the world, essentially. That liquidity washes in and out of markets. So when it washes out of markets, as it is right now, they're raising interest rates and they're reducing the balance sheet. That's taking money out of the system. So it's a game of musical chairs. So what happens is people are scrambling for dollars, and both, you see currencies falling around the world, but also people can afford less assets because there's less leverage, less money around. So the price of Bitcoin, NASDAQ, everything falls. I mean, literally everything, house prices. And the dollar goes up because there's less dollars around.
That's what's happening right now.
That's happening right now. So if we go back to 2020, what happened was massive liquidity coming in, plus debasement of currencies, quantitative easing. Right now, we've got the opposite of debasing of currencies. We've got quantitative tightening. So the currency is actually getting stronger. So the assets should go down versus that. But back then, we had like a 50% increase in the Fed balance sheet. We've never seen that much monetary expansion in the modern history of the United States. And so what happens is you then look at all of the assets, and what did best out of that was Bitcoin, or all of crypto. Why? Because not only, so gold did okay and equities did well, but Bitcoin did really well because you had both the technology bet and the monetary bet. And so it outperformed. So if we're in an age when the central banks are straddled, the global economies are straddled with debt, and this doesn't apply to India as much as it applies to the Western developed nations, is their only answer is to print money to avoid catastrophe, because who pays the debt? So the central banks backstop it. So over time, they're going to keep doing this trick because it's a magic trick, because it makes asset prices go up and everyone looks like they're rich. But you're not rich because you actually can't afford a house because it keeps going up in value because your wages don't go up. And the asset you need to own for all of that is crypto, because it's the thing that outperforms and gives you more purchasing power.
It's a hedge to inflation because it's actually you're better off owning Bitcoin than your own currency. That's how it's a hedge.
Yes, but it's not inflation as in the rising cost of gasoline prices. It's to do with fixed asset inflation, houses, stock market, Rolex watches, and art, all of that stuff that's supposed to hold value, that goes up a lot when you debase the currency. All of these things with variable amounts, like your wages, don't go up, which is why the rich get richer because they own all the stuff, and the poor get poorer because they just get income. and income never goes up as much.
Raul, one of the counterintuitive things that has happened as a result of this of QE, or more broadly, whether it's fiscal stimulus or monetary stimulus, is people concluding that you will end up in a world where the dollar goes to zero. And it has done the exact opposite, and it's like at a 20, 30-year high. You've been one of the folks, along with Brent Johnson, who have sort of talked about this in the past. Can you explain to folks listening why people like people like Jack Dorsey got this wrong, where they thought there was going to be hyperinflation?
First thing, let's get this public. I taught everything Brent Johnson knows. So I've taught him everything.
We're going to just cut this and paste it on Twitter every day until Brent just finally gives up and deletes his Twitter.
Okay. The US is 25% of world GDP. It is 87%. The US dollar is 87% of every trade transaction in the world. And it's also the most indebted nation in the history of the world. It's 100% of world GDP in debt. But not only that, everybody else is in debt in dollars. So when things get scary, you go to the safest asset, which is the dollar. But there's always a scarcity of dollars because the US is only 25%. So it can't ever generate enough dollars for the system until it massively prints dollars and then gives them out to people. So the dollar is always in short supply globally. And in recessions, it's in extreme short supply. So right now, because the Fed are taking dollars out of the system, the dollar is going up a lot. So over time, this dollar shortage just keeps playing out. Everybody uses the dollars because they have to, because 87% of trade is in dollars. So you've kind of got a gun to your head. You need to use dollars. So when India buys oil from Mexico, let's say, whoever you buy it from, or from Saudi, you pay dollars. That's neither of your base currencies, but you have to go and buy dollars in the open market to do that. Well, it's not your currency. It's not the Saudis' currency. Yeah, sure, Saudis pegged to the dollar because they have to be, because oil's priced in dollars. So this is the issue, is everything is in the dollar and nobody has it. And the US is in control of it, which is why those bunch of baby boomers based in Washington control the world.
So is it fair to assume it's like a marathon where, like, when they flag off, that's when they start printing and everybody sprints as fast as they can to the other end of the risk curve. And then, if there's like a freeze sign, everybody freezes and retreats into maybe it starts raining and everybody retreats to shelter, and that shelter is dollar, and everyone's waiting for the rain to stop again so that the checkered flag can go off. Sounds like an insane game that millennials are forced to participate in just to be able to buy a house. It's sort of like 2 clicks away from, some sort of unsupervised gambling.
And don't forget, for millennials to buy a house just means they have to take on more and more leverage, much more leverage than their parents took. So it becomes a riskier and riskier bet at all times. Now, that means that the central banks are aware of that, so they try not to let things go wrong. So what do? Print more money, which makes the house prices go up even more, so people have to use more leverage. I mean, what a mess. But that's the mess we're in. And you can either blow up the entire system and destroy everybody and all wealth, or you can try and do this and hope that over time that the purchasing power of money erodes the debt. That's yet to be proven out. The US did that in the 1940s after World War II. They kind of had negative real rates, so interest rates less than inflation for an extended period of time, so the debt burden went down. But we haven't done that very well so far. I mean, debt to GDP keeps rising.